Hello and welcome to episode 16 of Inspire and Inform, where I'm going to be going through a client case study today and really just helping you to understand your numbers and what it really means when you're looking at potential properties for your investment. But before I do that, I just want to share some really good news for first home buyers. As of a few hours ago, there's a lot of talk about the $25,000 home builder scheme grant that you can use now that towards your deposit for your first property. So that's really good news for first home buyers. The devil's obviously in the details, so more details to be released soon. It's literally just come out as hot off the press. My name is Colin Lee, and I'm the founder of Inspire Realty, helping our clients and people like yourself to build better futures together. My vision is to be one of the most trusted and transparent property investment organizations. And really in this series, our aim is to inspire and inform you and really to provide you with the tools to help you make informed decisions about your own property investments. You see, I've invested personally myself over 10 years ago. And since then, I've built a multi-million-dollar property portfolio diversified all across Australia. But I haven't always started that way. I came to Australia as a migrant just after the Olympics in 2000, as you would hear in my previous live sessions. And we really struggled for the first few years to try and make it happen for us in this new country. So lots of ups and downs, a lot of heartaches as well. I saw my family, particularly my mum and dad, really struggle through to get their first jobs in Australia. And they got a lot of rejections for being too qualified and not having enough experience. So it was kind of catch-22. But I've seen my parents struggled, and I made a promise to myself that I want to be financially free one day so that I can provide for my parents. In that time, I've made a lot of errors, mistakes, and lost opportunities. There were some great opportunities, but because I was in a situation, I couldn't really get into it. So I am where I am today, and I formed the belief that anyone, regardless of your background, your experience, how much you have now. I get a lot of that. I don't have a lot now. How much you have now, how much you're earning now as well. It matters, obviously, your starting point, but that can always be improved, and it's all about your mindset and your belief systems. So I believe that as long as you have a strong desire, you can make it happen. There's a saying, if there's a will, there is a way. But I just have to thank, I want to thank all my mentors that I've had the privilege to associate myself with. I've worked with some of the top property companies in Australia. I've worked with some of the top developers in Australia, and I've learned a lot from these mentors. And I certainly wouldn't be where I am if it wasn't for them today. So I've learned a lot, and really my intention and my goal is to inspire you and to share my learnings. One of the key learnings I've learned over the years is to always begin with the end in mind. And I'll just say that again, begin with the end in mind. I want to share with you a real life case study of a client who really didn't know what she wanted in life, let alone what she really wanted to do with her properties. I mean, she saved up quite a fair bit of money in a deposit. She's got a very good career, not affected by COVID. And she's just been sitting idle on that cash for a while, knowing that, putting that cash in the bank is not really going to help her to become financially free one day. And as my mentor says, you got to first begin with the end in mind, know what you want. You got to decide what it is that you want in your life. And then the next thing you got to do is you got to know what price you need to pay to get to that. I mean, you can't have everything and not do anything. So there's a price to pay for what you want in life. And lastly, if you know what price you need to pay, the sacrifices that you need to make along the way, you got to decide then whether you're happy to pay the price. So some of this price would mean that, there may be a bit of a short-term pain for a longer-term gain. But I can promise you it is worth it, if you just make some sacrifices now for your long-term future. So what I want to do is I want to go through a case study of a client. I'm just going to go through very quickly in the interest of time, just a snapshot of the consults that I do with my client. And this is a very, very powerful case study. So I just want to share my screen with you. So if you can see, I'm all about spreadsheets. I love my numbers. Not as much as Andrew. he's the number, he's the genius on all this. But these are the sort of questions I tend to ask my questions. So with this client, assuming her name is Jane Smith. I've had to alter the numbers a little bit just for privacy reasons. But say Jane Smith is earning $90,000 a year. And all we said was, what if we could replace your $90,000 a year income, say in 20 years? We're very realistic. She's in her late 20s. She's got many more years to work. She's not adverse to working. And she goes, Colin, yep, I'm happy to retire in 20 years and I'm on $90,000. Okay, good. And then we look at the inflation rate and cash return on equity being 5%. I won't go into details about that. But we spent a long time just talking what are some of her major goals and milestones that she wants to achieve in life. And we worked out, just to start off with, about 6 major milestones. So the reason why I do this is because property investing has got lots of ups and downs. And unless you are reminded of why you're doing this, it's very, very easy to give up along the way. So for example, she wanted her own home to live in 20 years, $2 million, obviously in today's money, in 20 years, it'll be a little bit more than that. She wants to have a family with 2 kids and put them through private schools. She wants to earn $200,000 in the next 5 years, set aside $20,000 per year to travel and experience the world, spend 2 days a week volunteering her time for a charity and church, and to donate $20,000 a year with what she has to a local church to build their missions outreach. She's quite a faith-filled person. So we've done this exercise and we've realized that she needs, all in all, in 20 years, by 2040, she'll need about a $3.2 million net equity. Net equity is the total net worth you have after releasing all your mortgages, with the properties that you have under your possession, really. So we figure this out. This is a fairly long-winded process. I really take my clients through this coaching process, and then I show them this. I'm not going to go through it in detail, but assuming Jane earns $90,000, she's got about $150,000 in savings and about $100,000 in a super. What I'm able to show Jane, and by the way, this is not financial advice in any way. That's just a little disclaimer. You need to speak to your accountant if you want, more accurate and definitive answers. This is just a general visual for, Jane's situation. It's different for your situation. With Jane, she's putting aside $250 a week, and she's got, super that grows at 9.75% in her contribution. And really, if you look at it in 20 years, by 2040, she's not even close to where her target is. The red line is really where she wants to be, just conservatively, getting $90,000 in passive income a year. I'm not going to focus too much on this, but I really want you to just experience what we do during our consultations, which is completely free of charge, by the way. If you're interested in having a discussion with myself and one of my team members, one of our strategists, feel free to make an inquiry on our website, and we'll be in touch with you within 24 hours to book in a time to have that consultation and work through your scenarios with you. One of the important things about looking at property is, like I said, to know your numbers. And, with her current future with Jane, the future is not bright. If she just went along, if nothing changes, all she did was put $250 aside, and she grew her super from 100,000, assuming in 20 years it grows at the rate that it is growing at. But this is where she'll be at. So really, it's not that enough. So which means the alternative is for Jane to then depend on her superannuation on its own, or at the time when her super runs out, she'll have to get on the pension, which, once again, we hope that in 20 years, the pension rates are still enough for an average person to have a fairly comfortable lifestyle. The ATO says we need about $40,000, $45,000 to retire on, to live fairly comfortably. And I just know that your pension's just not going to be enough. So the future is not very, very bright for Jane if she does nothing, just keeping the same situation she's on at the moment. For the purpose of time, I just want to spend the next 10 minutes going through some of the things that I really do with my clients. And with this particular client, Jane, for example, she didn't really know how property investment worked. That's why she was very afraid to get into property investment. She didn't know her numbers. She didn't know how much deposit she really needed. She didn't really know how it works from a cash flow perspective, how much money extra she needs to put out. And she certainly had no idea. I didn't know anything about depreciation for the first 2 years of my investing career. Obviously, I claimed it after, but that's one of the things you learn when you're surrounded with mentors and people who've been there and done that, made the mistakes that we hope that you don't make, so that you can maximize your investment property portfolio and generate that investment asset, for your future. See, I believe that investing in property is like running a business. You got to know your numbers. You got to know how it works. You got to know the cash flow. So once again, without going into too much detail, I think this is a very, very important exercise to do. So Jane had the idea that she wants to invest, and she was kind of toying between Queensland and New South Wales. So I showed her a couple of options in Queensland. I showed her a couple of options in New South Wales, in Sydney. But because of her budget, she couldn't really find anything that's too close to the CBD in Sydney for her price point. So we really had to look a little bit further out. And when you start to look a little bit further out, I'm talking as far as potentially Newcastle, for her to really afford something decent. The idea then quickly switched to, okay, well, maybe let's consider something in Queensland where the cash flow is a little bit better and the yield looks a little bit better for her for the long term. So there's pros and cons for everything. I'm not, promoting Queensland as per se. It is really up to your situation, your financial situation, after talking to your banker or broker, and then coming back to me to look at what you can afford and how it works from a cash flow perspective. So in this case with Jane, I said, look, okay, let's look at some options. I believe in townhouses. I believe, in units, and I believe in house and land. I believe in all different types of products. It's just what suits you now, and make sure that you have a diversified property portfolio. So we looked at an option in Queensland at the moment. It's a townhouse, literally about 20 minutes from Brisbane CBD. It's a 3-bedroom townhouse, 2 bathrooms, very, very big open space patio at the back. And it's very close to the third largest shopping center as well in Brisbane. It's a shopping center called Chermside. So that's a really good suburb. I know it's an emerging suburb. There's no way Westfield would spend all that money and construct the third largest shopping center in all of Australia in a suburb that they don't think is going to grow. So we know there's a lot of good potential in this place. It's $459,000 for the 3-bedroom townhouse. Now, so she's got 200,000. And one of the things I tend to like to encourage my clients to think about is not to utilize all their deposit quickly. Got to have some buffer just in case things like valuations of the property don't stack up as much as we'd like to think it is. Unfortunately, because of COVID, valuers and banks are starting to take a little bit more of a conservative approach when it comes to valuations of property. So always have a little bit of backup. Don't try and be too optimistic and then find yourself having to find money to be able to settle on the property. So she's going to put 110,000. That's about just over half of what she's got available. So she still has about 90,000 that she has up her sleeve. Obviously, you got to pay stamp duty, and it's about $16,000. I'm trying to keep the loan to value ratio. In case you don't know what that is, that's just the amount of money you borrow against the total value of the property at 80%, just so that we can, look at the option of not paying lender's mortgage insurance. Because she has the money, she doesn't really need to pay the lender's mortgage insurance. Unless she wants to buy another property soon, then yes. So it's about your risk profiling as well. So in this case, we looked at a 3% interest rate. I'm not going to, talk about interest rates, even though I've been able to help my clients get, down to about 2.59 as of today, some interest rates for investment property. So let's keep it conservative at 3%. And therefore no LMI, and solicitor's fees could be $1,500, but let's just use $2,000, and it's a P&I loan. By the way, this is for illustrative purposes. It's not, all detail at the moment because I'm using some hypothetical figures at the moment, as accurate as I can make it. So her annual rent based on the property, by the way, I'm also able to get a 5% rental guarantee on this property for 12 months, 5%, which is very decent money. So 5% of 459 is about $22,950. That's a guaranteed rent for the first 12 months. She has to pay strata, insurance, and property management fee, which is about $1,767, and then interest of $19,000 as well. That's the P&I on on $337,000, minus the council strata rates, minus your letting costs, your vacancy rates. In fact, you know what? I'm going to take out the vacancy rate for the purposes of this exercise, so you know what the cash flow position is, because for the first 12 months, you're not going to have any vacancy with the rental guarantee. So this is a situation for the first year. So what we are able to show is the total revenue of the income coming in from this property is about 22,000. This is purely from the rent. You subtract all your cost, and therefore your total expenses is 27,000. Your total cost outgoing is about 4,088. This means you got to fork out 4,088 cash flow gross at the end of the year to be able to keep up and sustain this property. But hang on. There is the total gearing that you can offset against your income, and also your depreciation. So the depreciation, I went to a simple website and I looked at the, plugged in some figures with the depreciation schedule on a $459,000 property, brand new in Brisbane, and entered how much it's worth, and it produced this for me. Now, without going into detail, let's just assume at this point in time, we're going to use the diminishing value for the property, which means for the first year, you can claim up to $12,000 in depreciation for the property. So we put $12,000 in there, no deductions for LMI, and $16,000 in total for tax deductions. She's earning $90,000. On $90,000, she's paying $20,000 in taxes. Obviously, she owns 100% of it. I can do the same calculations on a couple, by the way. And so her tax deductions are up to $16,000. As you can see, that's made up of $12,000 depreciation and about $4,000 in total gearing. So all of a sudden, instead of paying $20,000 in tax, she gets to offset her $90,000 income and subtract the deductions of $16,000. All of a sudden, her new net assessable income is $73,000. Obviously, taxes are all according to a scale. That means her new tax payable is about $15,000. And what that really means, at the end of the year, she sends the depreciation schedule, does all her tax, and then she gets a tax refund from the ATO to the tune of $5,229. That's cash. But obviously, at the end of the year, unless you decide to work it in throughout your tax throughout the year. But assuming this is just the normal stock standard, she gets about $5,229 back into her account. So what that means in totality, in actual fact, her net annual cash flow is about $1,141. That's positive. That means this property that she's looking to purchase is positively geared. And that equates to about $22 a week in her net weekly cash flow. So I wanted to just kind of show this to you. It's in by no means in any way trying to pitch any product for you at this point in time, or very importantly, that we understand your situation. We understand, what your goals are, what your objectives are as well, what your investment risks are. What do you want to do in the next 5 years? If you want to purchase your own properties, investing in a property now, the right track for you. There are a lot of questions that I ensure that I'll ask before I even position any product for you. But as and when I do that, I will go through the numbers with you. The other thing I want to say is you got to make sure you know your numbers, not only from a property perspective. That's, on one hand, I've been working in the property industry for many, many years, and I've seen that the property industry is great. A lot of them are very optimistic about a lot of things, about capital growth, about valuations, about a lot of things. And I think that's great. I think that can potentially be dangerous if you don't understand the financing part of it. So as a finance broker, I don't normally do finances for all my clients, but I'm able to give you that sort of aspect, that second opinion, the strategy for financing, and have some sort of contingency plans. I've been seeing a lot of clients from, many different walks of life. They come to me and they have problems with trying to settle their property right now. And I think that's because from the very beginning, the finance discussion was never had. It was never structured properly from the very beginning. So there's a lot of problems that they're encountering during the settlement phase. Okay, let's put it that way. I made the same mistakes myself. I've had challenges settling on my property. I've had to sell, a couple of them just to make it work. So I know what it's like. Life takes a turn. Things happen, obviously. But you just want to make sure that you protect yourself and have those discussions, have those, really tough discussions. What if this happened? What if that happens? And we stress test you to make sure that you're still able to invest in the property, not only exchange it right now and put that deposit down, but ensure that you have the ability and the funds to be able to settle on the property. That's the second thing. More importantly, the capacity to hold it for the long term. And that's why the cash flow situation and your calculation is very, very important, because you want to know how much are you putting out on a year-to-year basis? What if the rent drops by 10%? How much do you need to put, how much do you need to fund and pay extra to maintain your mortgage? So there are a lot of these questions. Like I said, there's SDI, and I hope that I hope it's us that you have that discussion with to work out your property strategy and your financing and your numbers. I wish you all the best, and we hope to connect with you sometime. Please visit www.inspirerealty.com and watch our episodes every week on Wednesdays at 6 o'clock. We do a live telecast. It's usually myself or Andrew that will be running workshops, seminars, live broadcast on a week-to-week basis. So we thank you so much for your time. Some of you are watching live. Some of you will be watching it after live. I thank you so much for your time, and I look forward to chatting with you individually. Thank you, and have a nice day. To a better future together.